Joining us now, Steen Jakobsen, Saxo Bank's CIO. Steen, 6 months ago, 9 months ago, there was a positive narrative around Europe. Europe seemed to be on the front foot when it came to fiscal policy. Europe seemed to have a better narrative to tell when it came to controlling the virus. All of that has completely and utterly been thrown out of the window. The US is now on the front foot in controlling the virus. The US is on the front foot when it comes to delivering fiscal policy. What is your assessment of where Europe is right now and the case to invest money here?
Of course, the even bigger irony is the fact that Europe has outperformed the US in this environment in terms of the stock market, if we start there. But you're absolutely right. The difference between the fiscal dominance, which I think is the real theme, so fiscal dominance being easy monetary policy by central banks and fiscal deficit to infinity in terms of the fiscal land of the law, is clearly far more potent in the US. And of course, that is the restriction of the EU and the ECB as well. That the fact is that you can do a one-off deal like the green budget that the EU tried to do, and the deal that was very heavily negotiated to get some relief for all of Europe. But at the end of the day, what remains is that Europe is not a fiscally union. It's not able to actually get its act together. And in doing so, they will be late to the party. So I don't think it's really surprising that they're late to the party and they don't have the ability. I think what is sinking in right now to the market is that ECB is caught in a corner. I think the last press conference by the ECB board was very clear. They don't actually have anything in the toolbox right now that can protect them. And one reason is the rising US interest rates. So, you know, it was all good Latin, so to speak, to do and buy Greece when it was yielding 100, 150 basis points. But at these levels, you can actually do much better as a European investor by buying a 5 to 10 year US and swapping it back into euros. You can pick up 50, 60 basis points relatively to the peripheral Europe. And that constitutes the real problem for the ECB, that there are simply better alternatives for people who wants to place bond money, and of course bond money being fixed income money being the biggest portion of most institutional managers today.
So Steen, are we back to the US exceptionalism for longer story? And I guess for how long? Because the EU will vaccinate, right? That will happen. But if the timeline gets pushed out, that could deal with perennial underperformance. It just cannot catch up.
Absolutely, but I also think we have to be clear about the movement in the US fixed income market. The US is not really issuing a lot of money because the general account sits with a big surplus. So I think to some extent we're benefiting from that pause in raising a huge amount of money. They're still raising money, but it is significantly less that should be enabled. Was it to finance 1.9 trillion just gone out? And of course the infrastructure. So I think when we get to the other side of the general account being run down at the latest by August 1st, you start to see that spreads in the US will widen, and that widening of the spread has a convexity impact on risky assets. And in that case, the US is still a very expensive market, and relatively speaking, Europe is a very inexpensive market. And I think what the guy has been talking about a few times, and probably you as well, is that, you know, the move by Volkswagen, by any standard, I think is a paradigm shift in the world of technology and the ability to offer the product that the future needs.
Yeah, we're going to talk a lot about that. Certainly Herbert Diess getting a very positive response in the market today. But Steen, Europe can do that industrial pivot. My question is, can it pivot kind of away from that process? The US is driven by software at the moment. China has a technology sector that is kind of under pressure at the moment from Beijing, but nevertheless is incredibly strong. Europe needs a growth driver, and I'm still struggling to see where that comes from. It was meant to be green. Europe was meant to be the dominant force in green. The US is about to produce an infrastructure program that is going to be absolutely enormous. And a lot of that is going to be focusing on green. And again, I come back to this point. You compare and contrast the two. If the US is getting into green, it's going to dominate. Where do you want to put your money? Do you want to be with that dominant force?
I don't think you need to put your money in one specific geographic region. And I think that's really what's changed over the course of the last 5 years for guys like me and you, Guy, is that you cannot just boil it down to a single market or single geographic. It's really the talent on the ground that's going to make a difference. And that's the big game changer for Volkswagen, one of the biggest research and development teams in the world. But let me go back to the fundamental question here. The fundamental question is, I think that the next 2 to 3 years, maybe even the next 5 years, tangible assets, what you call the old industrial sort of might, I think is coming back because we have this shortage, we have supply bottlenecks, we need ships, we need shipping routes, we need containers, we need electricity grid builds out, as you rightly say. We are far behind in terms of the green transformation in Europe and the US, but they are further back in the US than we are in Europe. So to a large extent, I think we have a competitive edge in the short term in the European market. But again, I only want to be buying companies that fits the theme with which I'm supporting, which is the supply side of the economy. It is the mining sector. It is the, if you want to go carbon free, you're going metal intensive, right? Mm-hmm. So to some extent, you need to be a global investor today, Guy. I don't think you can restrict yourself to selection on your domestic market.
So how does that look like compared to what we saw in 2009? I mean, that was led by China and their investment cycle in manufacturing. You're describing a lot of the same type of things. Is that led by China this time? How does that look?
No, and I think that is the missing piece in the real inflation story. I think we've had this conversation between the three of us for over the last 6 months. I was early in late last year saying this is about inflation and ultimately the bottlenecks on the supply side of the economy. But this time, China is running an asynchronic policy. And going to the platform story that you just had for Xi Jinping, it's pretty interesting that let me be diplomatic, the autocratic sort of governments around the world are cracking down on this technology platform and the assembling of data outside the reach of governments. And now they want to transfer it into the reach of government again to reset the power base. I think autocratic government actually leads in what's going to happen to the rest of the world. And in that sort of infinity and beyond valuation that we see in terms of the convexity, I mean, the duration in technology and momentum stocks is the equivalent of owning 30, 35 years of fixed income. Of course, there is a price to be paid. So I think for the prudent investor, he and she makes sure that they are invested into a diversification of some volatility, probably a little bit of crypto, certainly playing on the themes of green transformation, infrastructure overall. And as you can see, what I'm trying to set up here is not a portfolio that is heavily overweight the platform and the high free cash flow generation, because that very high free cash flow is not based on earnings, but based on a discount rate, which I think is almost inevitable and to move in terms of the 10-year to at least 2.5 percentage points.
Where's the BTP if treasuries are at 2.5? At the moment, there's a 100 basis point spread. Let's assume that we get up to 1.6 on a BTP. Can Italy take a 1.6 BTP?
No. And that goes back and circles back into the first to the initial question about Europe. The difference is that not only does the Federal Reserve accept, but they also need an increase in the nominal rates in order to finance deficit that is there forever. I mean, if you look at the CBO, the expected average deficit in the US will be in excess of 5% of GDP. There's a saving rate of 25% in the US, meaning that foreigners has to participate. That participation is built on two things, either a weak dollar or an interest rate which is high enough. I think Fed is smart enough to know that they need to see the long end of the curve go up as long as they can control the short end. Opposite in Europe, where you have a central bank and an oval system, as you exemplified by Italy, where there is a maximum to the financing rate. And that financing rate, and that is my point, is already being undermined by the fact that right now, as a European investor, I can swap fully currency hedged into US equity, fixed income, and get a higher return, which means the marginal utility of the carry in BTP and in Greece and in Portugal is not worth anything anymore. And that creates the real problem for ECB, that even supporting through the PEP program and trying to keep the spreads tight is not going to change the fact that the nominal rate you get in return, it's much higher in markets like the US. And for anything, it's going to be high as well, in my opinion.
So what happens, though, if the Fed can't control the short end? There's a real conversation in the market that they'll lose control of it.
You have to believe that the Federal Reserve's got the plumbing in order to some extent, and the fact that the Powell is not reactive enough yet is a function of that. But I think if you look at the market, if you look at the MOVE index, which is the volatility on bond market, and the VIX index, the divergence between the two is pretty clear. It seems like for the meeting tomorrow that the equity market is saying there's no concern, they will come up with some sort of solution. Whereas the bond market is, like you say, are far more uncertain because, of course, the move remains elevated. So the spread between the two indicates the fixed income market being very concerned and the equity market not concerned at all. They see through this as a short-term policy mistake that there hasn't been clarification on it. But let's remember, if we do deal with this general account rundown and the negative repo rates, we still have to deal with the fact that the QE in size is too small for the monetization of the US debt by the Fed. So Fed still need to address that as well. Fed also needs to address whether the expectation of YCC. Personally, as you know, I'm not a big advocate for YCC before it's ultimately needed. But that conversation will continue. So I think what is happening right now is the Fed has put themselves into a corner from which they can deal with one issue at a time, but that will be perceived by the market to be too slow. So I think there is a huge event risk tomorrow in a sense that Fed will deliver something probably, but it will be mechanical and not forward-looking and not giving the clarification on the other issues I just raised.